Are you doing all 7 of the following tax smart initiatives? 1. Declaring all income. All income you receive when you rent out your property must be declared on your tax return. Now this includes your share of the full amount of rent you receive or become entitled to. Now this also includes rent or associated payments that you may receive or become entitled to. Now, for example, what do I mean? Bond money. If you receive this back due to tenant default on rent or damage to the property, you may receive an insurance payout to compensate you for loss of rent and associated payments. Now this includes all amounts you receive. 2. Keeping proof of all expenses. Anytime you spend money on your investment property, you should keep proof of expenditure, such as a receipt. Now, there are 3 categories of rental expenses. Those for which A, you cannot claim a deduction. B, can claim an immediate deduction in the income year that you incur the expense. Or C, you can claim a deduction but over a number of income years. Now, in regards to these categories, there is a lot of detail, and this can be referred to on the ATO's website, link below. Now, track when your rental is in use for private or as a rental. If you or your family or friends stay in your rental property for free or at a reduced rate, this will affect the expenses that you can claim for that period. Now, this one is pretty self-explanatory. Simply, you can't claim a deduction for the portion of any expenditure that relates to your private use. 4. Now, you can only claim interest expenses on the part of the loan that relates to your rental property. Now, you can claim interest charged on a loan relating to your rental property. However, if you've used part of that loan for private purposes, such as to buy a new family car, you can't claim interest on that part of the loan. I guess simply you must apportion the interest expense to account for the private use. 5. Now, claim improvements or initial repairs as capital works. Improvements such as renovating the bathroom or initial repairs for damage that may have existed when you purchased the property. These must be claimed as capital works expenses and spread over a number of years, not claimed as an outright deduction. Repairs generally involve a replacement or renewal of a worn out or broken part. For example, replacing a worn or damaged curtains or blinds or carpets between tenants. Maintenance generally involves keeping the property in a tenantable condition. For example, repainting faded or damaged interior walls. However, expenses which are capital or of a capital nature are not deductible as repairs or maintenance. The following examples of expenses which are capital or of a capital nature, such as replacement of an entire structure or unit of a property, such as a complete fence or building, possibly a stove or kitchen cupboards or a refrigerator. Improvements, renovations, extensions and alterations, and initial repairs, for example, in remedying defects or damage or deterioration on that existed at the date that you acquired the property. 6. Correctly divide the income and expenses of co-owned properties. Now, if you share ownership of your rental property with another, you will need to divide the income and expenses accordingly to your legal interest in the property. This varies. Now, this depends on whether you are co-owners, a joint tenants in common, or there is a partnership carrying on a business of letting rental properties. 7. Increase your knowledge. Now, the ATO's website contains a wide range of useful information, including an in-depth guide to rental properties, along with real-life case studies. For further information, jump online and visit www.ato.gov.au/rentals. Thanks, guys.